think we have everybody kind of, I'll add people as they come. I know that maybe most of you are not like my dad, who didn't forget Valentine's Day and hopefully have something planned later. Guy, you got a big fancy romantic day planned for?
Yeah, with the kids right involved in it.
That's how it goes, right?
That's how it goes right now.
Yeah, well, I will tell you, my boys were able to tell my mom what the meaning of Valentine's Day was like, and it all started from Valentinius, who was a priest, and at the time where he was at, they weren't allowing marriages because the king wanted everybody to go serve in the army, and he would marry people in the darkness and in the night to make sure that people could still have Christian weddings in a time where Christianity was persecuted. So, anyway, there is some really good meaning behind Valentine's Day
Oh,
that the boys were to share.
Saint Valentine. All right.
Yeah. So, Valentinius, you can look him up after.
Valentinius. Yeah.
All right. Well, thanks again for joining, Guy. I know this is our what, like our fourth annual or something, State of the Union, we call it, kind of market
Yeah.
update.
Yeah.
It's amazing how fast time flies. But I thought we'd talk. What I found interesting, and for everyone listening, all of our past recordings, at least the last couple, are on our website, and the transcripts are there. What I say by that is I had an issue this year where almost all of our videos were deleted. So I know I had last State of the Union, hopefully the one before that, but some of them. Um, just became deleted on me. So luckily we always have the transcripts available, so that's there if nothing else. But what I thought interesting, Guy, you and I were talking about this right before, is if we went back and listened or kind of reread some of it. I remember last year specifically, the things we had talked about the year before was the exact things we were kind of recapping, on what you'd saw happen and the changes. And then what has been happening is usually about the end of the year, you're kind of already making shifts into the year ahead. Uh, Based on what that was seen. So it's kind of cool to go back to those old State of the Unions, and anyone is available to do that. And you can kind of see, oh, yes, the things that we were seeing ended up kind of playing out. Then the trends that we saw at the end of the year, we're starting for the next year and we're making adjustments. And so it just goes to show that Guy and the team here are already on top of it and making those adjustments. But those are there. But Guy, I'll let you take over. And if you want to share anything from last year and then going forward into this year, we'll jump right in.
Yeah. No, absolutely. So, last year ended up being another, good, strong year. And with a little more participation in the overall breadth of markets from the year prior. But we still had leading and outperformance from certain sectors, and primarily within technology and communications. So a lot of that is with the Magnificent Seven stocks that, we are constantly being discussed. But especially into the fourth quarter, we did see, some more performance within other sectors as well. But when kind of looking at the overall scope of different market indexes, you can see the index performance kind of shows there was still that differential that, not all stocks acted the same last year, and there were some winners and some that were, still a little muted, a little more stagnant. So it was led once again by tech and growth. So cap weighted S&P 500 was up about 25% last year. And the NASDAQ, which is very, basically all tech heavy, about 29%. But if you kind of go more towards the value realm and other sectors outside of that, the Dow Jones was up about 15%. S&P value based index was up about 12. If you look at an equal weighted S&P 500, which doesn't overly weight to the high capitalized sectors like tech, but more of a true representation of the top 500 companies in our economy, that was up about 13%, and small cap was up about 9%. So overall, most indexes overall hit that double digit return last year, but obviously it was more in the 20% type realm if you were in more of the right places. And happy to say that most of our core, four of our core strategies exceeded that 20% mark again last year between growth and income and tops, core quality, growth plus. growth and income, which is our core strategy that, most people have the most exposure to, once again, exceeded the S&P 500 for actually now the third year in a row. So the gross return on growth and income was a little over 26% last year. So it was, and within that strategy, that has most of our dynamic and tactical thinking associated with it. And when you kind of go back and correlate to the some of the trends and things that we were thinking of, that was being mirrored in particular within that strategy. So, what did we really see last year to have a result of those different performances within the indexes? And really, the story was we continued to see robust, good, strong earnings growth. And what it was really backed by was a resilient and still very strong consumer, which was probably backed by the fact that we still have very, strong employment data and unemployment numbers and things that are continuing to drive the consumer. So we continued to see that trend. And what we did, we kind of had mentioned, we were, kind of countering those strong economics along with kind of watching where valuations were, and the tech and the sectors that are doing really well. Of course, the valuations were also kind of trending up, even though their earnings were also going up. But at a point, we were starting to rotate to other sectors, really starting in May, June, July timeframe. And the function of taking profits from those sectors that were doing so well, not getting out of them, we're still keeping a core exposure to them, but taking some of those gains off, some of those profits off, and then redeploying them into some of the sectors that weren't, in particular, like the cyclicals. And when we're talking about that, that's looking at cyclicals and defensives like the banks, some energy exposure, and also industrials. And at the time that we were doing it, the reason we were really thinking of doing it was because we were kind of trying to watch where the money was flowing when it came from, government budget. And with the last budget that was passed in March or April of last year, a lot of the money that was being allocated through that was going direct to industry this time versus the last couple of years where a lot of it was going directly into consumers' hands. And so we knew that would especially potentially influence and go into the industrials. So a company like Parker Hannifin that we had within the growth and income portfolio. And so we knew that would eventually translate through to earnings growth. But then we had the election, which the results of the election with kind of an anticipation and now some deregulation, potentially lower taxes, that is now benefiting those sectors that we were already starting to put more money into through the course of last year. So that just kind of speaks to the fact of us trying to be nimble with the data that we're seeing, to be proactively making some of those adjustments, just to continue to try and put the portfolios on that best foot forward. And the only other thing I'll also say is the Fed, because in the very beginning of last year, the market expectation was that we might see up to 6 rate cuts with the Fed. We were seeing the same data that we were it was continuing to be in a very tightening scenario as inflation numbers were going down, and they were keeping Fed funds rate in that 5.5% range. So the indications were that they should be cutting. We were a little, we weren't quite sure if it would get to 6 or not. And at the end of the day, what we ended up seeing was the Fed cut 3 times last year. But the first one in September was a 50 basis point cut. So in aggregate, they cut about 1%, which would be considered 4 cuts of 0.25% each. So we did start to see some of those rate cuts as inflation data did start to finally come down into the ranges that the Fed was looking for.
Makes sense. And I think you hit some other key things that, while we do these State of the Unions at the beginning of the year, and it's twofold, to look back at last year and to think what happened and then to look forward into the next year. You just hit on some keys that it's not all done right now, right? You're active all year long. There was things that we kind of saw at the beginning of the year that you were already watching and started making changes towards summer, from some of the valuation standpoints and taking some of those gains off the table. And I would guess the same as this year, like we can kind of give a summary now, and it's great to hear what happened. So what you did last year and then what we're looking at this year, but it doesn't stop, now, like it continues all year. Sometimes we do a mid-year, update. It depends on the year, but I just wanted to point that out that while things that we're talking about at the beginning and you're looking, and I always think the beginning of the year is people are looking ahead. But your job doesn't stop at the beginning of the year. There's things that are being changed and made throughout the year based on what's happening, correct? So.
Absolutely. It's constantly changing. It never ends, just like the news cycle, right? So
Yeah. And I think some of those things that you were seeing is probably leading into 20, like I know we were talking about some of the businesses that might be set up for more opportunities this year with deregulation, with some of those things. So if you want to continue on that a little bit, that would be, I'm sure, what you're seeing into 2025, at least at the.
yeah, yeah, exact. So what we're seeing is now there is that opportunity for the next step up on to increase the market breadth, so basically potentially start to maybe even see at least inline performance or even outperformance in other sectors other than just the technology and communication sectors that have been leading the way really for the last 2 years. And there is now expectations to be seeing up to 15% type growth within those types of sectors. And that is now even further backed by some of the expected pro growth policy that could be more influential and more impactful for some of those sectors, like the banks, like certain healthcare companies, things that are maybe have a little more regulation bearing down on their business. And if that's starting to come off, it could be helping on their business. And if we start to see, a catch up in that valuation gap, so a lot of these sectors are much more undervalued versus, the ones that have been doing well. So that's why it's important that, we started to make that shift there. And, we will continue to make that shift. One dynamic we're actually been seeing is we've been seeing an improvement in what are called LEIs, they're leading economic indicators. So what would be inclusive of that is things like retail sales and housing starts and building permits, uh, the PPI, which is the producer price index. So that's really just showing producers or companies how much are they ordering supplies ahead in anticipation of more production and more growth. PPI numbers, yield, the yield curve steepening. So all these things that we keep our eye on every single month since the fourth quarter have now been improving. LEIs have been improving, and to the point where actually for the last 18 months, the LEIs were indicating that we could be heading into a recession because they were actually a lot of those things were kind of contractionary, and not growing. And that turned a bit into the fourth quarter and to the point where finally those LEIs weren't necessarily even indicating that we were heading into recession. So that's why in the past, 2 years, a lot of different firms were looking at them, and a lot of people were anticipating we were heading towards recession. Um, our view was that we weren't doing that, even though the LEIs were indicating we could be going there, mostly because of the strength of the consumer and the strength of those employment numbers that I mentioned before, because we had never entered a significant recession when unemployment was so low and the consumer was so strong. So until that changed, we were not going to be changing our point of view on that. So now the LEIs are actually changing to the other way to be showing more expansion potentially. And we know now historically, as LEIs improve, we know that cyclicals outperform. And so what are those? Those are the banks, that's certain consumer discretionary stocks, with Amazon, and oil and gas stocks. So, those are some examples of that. So if we see those continuing to improve, we will be continuing to put into those sectors, which, by the way, are pretty, for the most part, at lower valuations than the tech and some of the other things that have been doing well. So that's just what we're currently seeing now, and some of the trends that we will continue to follow. And I mean, I guess the one other thing I'll mention, especially on the energy front, that we've started to get exposure to, is it's with anticipation of more and more need for, with this data center growth and energy usage when it comes to increased capacity with AI. And it's just knowing that's going to be a need for a lot of energy. So that's why we actually, enter new positions in company like LNG, which is Cheniere Energy. So that's liquid natural gas, Constellation Energy, which is on the nuclear side, and also Eaton Corp, which that's actually just more on the utility side, but it's energy. It's basically energy production and management, electricity production and management. So all those things are going to be key things if we continue to see more and more build out, more and more reliance on data center usage when it comes to AI. So these are just examples of, from an opportunity standpoint, the adjustments that we're making and trending into the portfolios.
Makes sense. And then I think another topic we talked about a little bit was, tariffs, which right now have seemed to be used a lot as a negotiating tool, but you kind of talked yesterday about how they can be deregulatory in, I think that was the word used in general. So if you want to
Mhm.
expound on that a little bit and some thought, because I know there's a lot of, so no, I guess fear kind of goes on and worried about price. And so if you want to just kind of hit on a couple of those things with what you see with the tariffs.
Yeah, so that's what we're looking. I
Tariffs.
mean, the two things up front and focus right now with the new administration are primarily the tariff talk and the what's going on with government spending and Doge. Those are really the two things that are up in a up front right now in terms of being talked about a lot. And from a tariff standpoint, you're absolutely right. It still is, we need to see what that will actually come to, because at this point, it's being used as a negotiation tactic. We can see for, with the 25% tariffs that we're going to be put on with Canada and Mexico over the weekend. And then by Monday afternoon, they're now on a reprieve, to now negotiate and try and get to a point where, they're not going to be put on, or maybe they will be put on, right? So to this point, it's still in that zone, even though there were more that was put on China, and there's now with steel and aluminum being put on. So from an analysis standpoint, it's hard to see the actual overall impact of these when you don't know what's actually going to be going on, to what extent, and for how long, which are all very much uncertainties. So from a risk management standpoint, what we can know a little more for sure when it comes to tariffs is that there are going to be more sensitive sectors to them if they do come on. And that's in particular things like the automakers and home builders, of food processing and packaging, agriculture, especially because a lot of even some of your clients may know, some of the fertilizer and things that are essential for it come from Canada and places like that. um, and then also certain consumer goods, so those are from more of the direct effect of a tariff within an industry. And then when you look within our portfolios, those are really all sectors that we have minimal to no exposure to. It's very, it's not very sensitive from our investment selection within those individual particular sectors. Now, the secondary effect of tariffs could also be, all right, how much is it going to hurt the consumer if they do come on more widespread and they do kind of spread across all different types of industries? Because the idea is obviously then the increased price passes on to the consumer, and it will become more expensive for normal day goods to be buying. How much will that crimp and hurt that strong consumer that I was talking about before? So that still is where it's very hard to actually see, or I've seen many different estimates that I won't even bring up because, it's
They're
from
all over
one
different.
person's point of view versus another of how impactful they could be. But, the counter argument to that is that the other side of things between potential decreased taxes, decreased regulations, how much of an offset could it be for industries with those things? So that's why at this point, it's not something that we are getting very aggressive with trying to protect on. I think our first line of protection is having limited exposure to the industries that are more directly affected when it comes to tariffs. And to this point, we'll have to see how much, and the other one I didn't mention was technology too, because technology is one that gets affected, especially with the ones that are on with China and, with certain things that are produced over there. But they seem to be, with how well that industry is doing, it seems to, they seem to overcome those costs kind of irregardless, that I wouldn't even necessarily put them as sensitive as these other sectors when it comes to the tariffs.
Makes sense.
Um, yep.
Well, and I think you hit on that a lot of time. The thought would be offsetting with some of the deregulation and the tax cuts and all those things that you don't, so yes, everything being the same, a tariff might cause goods to be higher. But if there's some deregulation in those industries, which makes it less expensive to run the companies, or if there's some tax cuts, it can offset. And those are things that, we'll see how they play out in the next, throughout this next year and how that happens. Correct. But
And an example of because what is being proposed on, and the tax stuff is still that's still hazy too. We're still hearing bits and pieces of what it's looking like, but on the one thing I know is being put out, it's going to have to go through reconciliation, and it's a whole process that, they're going to attempt to get done, but certainly hope, best case would be sometime in the first half of this year. But one thing would be potentially the extension of the 2017 tax cuts that were set to expire at the end of this year. And at that expiration, what would have happened is tax rates would have reverted back to where they were pre 2017. So that means, and this is for more, lower to middle American tier Americans, because the 12% bracket would then revert back to a 15% bracket, the 22 to a 25, a 25 to a 28, and so on. So, the extension of those, without that extension, that would have been a tax hit on the normal consumer for a couple extra $1,000 potentially in taxes they'd have to be paying. So if that now gets extended, how much will that now neutralize the increased cost they may see if tariffs go through, right? So that's an example of how it could be an offset, from these policy purposes. But once again, we have to see how these things pan out.
makes sense. Now, Guy, you and I were talking yesterday about what could have been, or what you were seeing as the next bubble, which I think we talked about just a little bit at the end of last year's State of the Union, which was the debt, the government debt, and then the spending and how much was going into debt. But you explained this kind of really well yesterday, which you were looking at, which I think will then go into what we're seeing with government spending. But do you want to just hit on that like you did yesterday for me?
Yeah, yeah. So absolutely, that was starting now. That it was such a shift, such a big change and shift from, that from when it came to our national debt and our budget deficit, um, that it was getting to the point where it could be building into, when we're trying to identify, bigger inherent economic problems for our country, you know, it seemed like it was starting to head in that capacity because, we're now up to $36 trillion of debt, which exceeds our GDP, which our GDP is now closer to about 30 trillion a year. But, prior to 2020, our debt had always been lower than our GDP. So it has now surpassed it and is now at, about 1.2% to, debt to GDP. And in addition, our debt interest payments have even gone to the point where they're about $1 trillion a year just to service the debt. which is exceeding our defense spending. And when and what's even more alarming is when you look at the budget deficit, because in 2024, we had about just under $5 trillion of tax revenue collected, about 4.9 trillion, but our spending was 6.75 trillion. So we were running a $2 trillion a year deficit, adding on to that debt. And so that's where it comes into trying to look and see what was very alarming, when you kind of look at it is, this was a stat that I think you were pretty interested in, was if you took the 2019, so the pre-COVID government spend, and you put that over last year's tax revenue, the 2024 tax revenue that was collected, we'd actually be at a $500 billion surplus versus a $2 trillion deficit. And that's because back in 2019, our government spend was just under 4.5 trillion, and we are now at 6.75 trillion. So essentially, that's a $2.3 trillion swing over the last 4 years in government spending, which, starting at a 4.5% spend in the first place, that's like a 52% increase over 4 years,
That's
right?
crazy. Yeah.
So that's where it just something, for it to be that extreme means, the hopes are that there are spaces to investigate that and look and try and cut down on it. The hope is that there might be some waste and unnecessary items within there that have just kind of gotten kind of rolled up over the last couple of years with everything that's been going on.
Yeah, and I think you made some interesting points yesterday as we were talking about. So we'll kind of talk about Doge, which is the topic that, creates different emotions in different people. But just a couple facts that we'll just hit. It is basically like an audit. And there is the Doge team has read-only access into this audit. So they're compiling information and data. And I think what you hit yesterday is, I mean, all companies should go through audits, right? Like you go through audits of spending to make sure that there's not wasteful spending, as you said, there's not fraud, there's not, whatever. But I think that you hit on something interesting too, that the government, well, we should kind of audit like a company, is not run like a company. Therefore, the way to do the audit becomes a little bit more challenging. And that's kind of what they're hoping to do with the technology and just to kind of bring things to light. But if you want to hit on, I thought you hit on that yesterday that I thought was interesting and good points.
Yeah. Well, it seems like part of the problem of why it kind of got so, it seems part of the reason it seems to have gotten so extreme is, kind of unlike a company, there's no really central controller on this, like a bookkeeper, when it comes to revenues in versus, invoice out, paying for service and reconciling it. The process seems to be that, Congress will appropriate, certain discretion to, certain allocations to different agencies to then have their discretion. The agencies then go to the Treasury to basically, get money for their orders. They tell them what they need. And there's no checking process of, revenues in against these orders out. It's just almost kind of rubber stamped. Whatever the agency is asking for, it then gets sent out by the Treasury. So there isn't that controller part to basically be trying to reconcile those things. And that's why we're constantly going over budget. We're constantly having these continual resolutions and fighting about, are we going to pay the things we've already spent, right? Which is kind of a ridiculous thing, but which has become a political usage of shutting down the government because we're not going to approve the things that have already been spent. But the root of the problem is because there's been no central control over it, and it's just, this unwielded spending. So part of the reason that we're running at a $2+ trillion deficit, so that's where it is crucial that there's some type of audit that can dive in and look and see where is the spending actually going, because no one actually really knows for sure right now, in an organized way at all.
Right. And I think you made a good point because people say, oh, unelected officials are doing this audit, but I thought you made a good point on why that might be, to the benefit. So if you want to hit on, and
Yeah,
again, and I think taking this to the point of not being political, but I think, Guy, what you said yesterday was really key too. We are looking at um, as from a risk management and how to manage investments. This debt was something that was going to create, could create issues. The hope is that through this process we find some of those answers, but what you're, kind of seeing why it might be done best to be done with non-election, and then what you're doing as investment advisors, kind of what we're doing, looking at it and how to manage with it.
yeah. And so yeah, my last I'm coming at this from, looking at it because we look at how businesses run their business, and even running our own business, and understanding that, and then correlating it to, like, that's not how the government is really being run right now, and probably part of the problem. But the one thing I'll mention is why it is why it probably has continued to be a problem when it's up to elected officials. The elected officials are really not incentivized to cut. What elected officials are incentivized to do is to fight for their constituents. Whoever is voting for them, it's their job to basically fight to get as much as they can for their constituents. And part of the problem obviously can be if someone is out there and really, campaign, really going for cuts, trying to be fiscally responsible, it's putting your neck out on, all right, well, what are we going to cut from your programs for your people, right? So that's probably very vague and basic, but it's a little bit of, maybe you can understand why the root of the problem, why we've had this problem for a long time with the budget, and why it could never really seem to be getting solved. And that's part of the reason, when you have, if you're leaving it up to elected officials to do it 100%. So, that's at least just the hopes of, what's going on right now, and why that could at least spur a little bit of a change, or at least moving the pendulum in the other direction. But from an investment standpoint, when we're looking, we also do know if there's going to be cuts in government spending, there is a little bit of deflationary aspect to that. It's less money that's going to be going out into the circulation. So that's all things that, from a rate standpoint, could be helpful if we can be getting spending down to a certain amount, in terms of the long end of interest rates that continually kind of go up. So that's why it's important for us just to be keeping an eye on it, and and kind of, what we do is we just try and make the best investment decisions we can based off of what we're seeing.
Right. And just think you hit a good point here, Guy. Like, this is something that it was created, it's a problem that was coming with the debt and the GDP and the continual raise of the debt. I mean, how many times have the government, been shut down or a threat to shut down because of spending issues in the last couple of years, right? I mean, it's becoming a bigger issue. How you solve that issue, I'm sure everybody would have different ideas in doing it. I think you just hit at some good points. Why maybe it's non-elected officials doing it, and whether you like who's doing it or not, who's doing it, it's something that's being done right now, which could turn out to be a positive. Time will tell. I think the other thing, and I'm just going to put it out there because it is all over the news right now too, is when it comes to being done by non-elected officials. And there's been, I mean, I think I just saw something this morning on a couple different news channels pop up that was the question, and what they're looking into. It's been stated is how are some of these senators, and this is Republicans and Democrats, this is not a party, specific, but how can they be worth, have had salaries of under 200,000 for life in Congress, or however long they've been there. Some of them have been there for years and years and years, and be worth, 200 or $1 million or 60 million, whatever it is, huge tens of millions of dollars. And I think that that is something that, and that they're looking at, and why that it's why they're choosing to do it in this way, without elected officials kind of looking at it. Because at minimum, I have some great smart clients. I mean, Guy, you and I were talking about this yesterday, and so do you, but I don't have any clients that made under 200,000 that have somehow come up with a net worth of tens of millions of dollars, or hundreds of millions of dollars. So that's probably something that should maybe create a red flag, and something that they're looking into is, at minimum, is there insider trading that was happening? Is there fraud that's happening? Is there something that's happening? And we need to have that taken a look at. And I know that that, again, has been on the topic for a lot of stations. And I think most of us could probably agree that smart people making under a couple 100,000 a year, no matter how smart they are, have a hard time making tens of millions of dollars of net worth. So something to that they're looking into. So I think in the end, we've done what, people vote. We continue there, and then watching it from a risk management perspective, you're seeing, hey, there could be some good things coming out of this, if we find where some of those dollars are going. And then, right now it's just brought up. I think one thing that's interesting, I think, is usaspending.gov is compiling all this data, is being publicly shared. And I think that is something that they're trying to be transparent as this is happening. So I don't know if you have any other thoughts on that, that we want to kind of end, but it is something, as you said, your risk management is to take what we're seeing, manage, and do accordingly. And so I don't know if you want to close on any kind of thoughts with that.
Yeah, I mean, we'll see what it comes out. Our hopes are that it's less of, finding issues with elected officials and net worth and so yeah, the hopes are that it's less of that ends up getting found. But what we're more, you know, concerned with, or at least it's a positive to us, is that this potential issue is at least being addressed. Because like I said, if it wasn't being addressed and we were just continuing to run $2+ trillion deficits each year, it was setting up for the next major economic crisis that could be happening. And especially now, because interest rate environment is not where it was for so long. This really was less of an issue when interest rates were much lower. But now when you're looking at the longer duration government interest at 4.5, 5% range, it's becoming more of a problem, especially when you keep running those types of deficits. So from a risk management standpoint, it's at least a positive. It's at least being talked about. It's being addressed. If there's transparency, opens up a discussion. This is all potentially good things, rather than just building on to a problem that we're already seeing is already not in great shape. So that's kind of our take on what we're seeing when we're watching that.
Yeah, and I think I was reading through some of the questions. I mean, I'll put some things out there. It's been stated, it's read-only access. Um, that's, I can put on there where I've saw that. I believe it's coming. I know I've saw it directly from a Donald Trump site. It might be on the White House site. I'll have to look exactly where I've saw that at multiple places. There's a couple other questions in the area of spending is reduced. Does that necessarily follow the month or hmm, if government spending reduces, does it necessarily follow that money supply will also be reduced, or non-government entities fill the gap with revenue and jobs? And I think you hit on a lot of things are still to be seen with how this is all going to play out. Um, and I don't know if you want to have any, but I think you just kind of hit on some of that. Some of these
Well,
things.
because money supply is more covered on the other side, the Fed side. So on the government spending side, it's potentially inflationary. It's just like any type of growth, any type of spending. It's inflationary. But the idea is that if X amount of it is non-productive waste it has an inflationary effect. If that starts to get cut out, that could be deflationary potentially. But money supply has more to do with the Fed and what they're, and because on the Fed side, it's not only just interest rates, but it's also on their balance sheet that they're keeping. So the more debt that they're accumulating up on there, that's more they're keeping the money supply in. If you, you know, if they choose to roll the debt off, which they have been, that's been the other side of it. People don't usually talk about. They're focused on what they're doing with the Fed funds rate, but they've also been on, I forget what the number is, how many billion of dollars a month they're rolling off that debt from the books. That's what affects more directly the money supply.
Yeah. Yeah. So I think, I mean, it's going to be interesting to see how it all plays out. I think I'll put some of the links in there, but I think you just made some good points that regardless on, again, how it's what we think might be done, and you made some good points on why it's probably best to have non-elected officials doing some things. It really is a data, as you mentioned yesterday, and I think you talked about today too, Guy, just it is a data collection because of how the government's run versus, Senate approving spending, going over to the Treasury and saying, hey, I need this spend, and there's not really the checks and balances maybe in play, especially as the government's growing and there's so much money that's going through that. So it'll be interesting to see how it plays out. I do think they're trying to have some transparency. I will put that link. I saw that there was a ton of data on it when I looked on usaspending.gov, which I think is compiling some of the data, but you hit some of that too, that because of how the books work, it's not like a normal business. And so what we are needing and what I think this is doing is more, how did you put it, tech engineering to go look and figure out where things are going.
Yeah, it has to be some forensic accounting, so you have to be able to follow the payments, and so that's which is usually now the trail. It's not a paper trail anymore. It's more of an electronic trail usually.
Yeah. And I mean, I think there was some interesting things that, had come out and, people said it's sad when we have waste and it is. But one data point I had saw, which again, I think this is what they're doing is, and correct me, but this is what I understand is kind of pointing out some of the data. And then it's, here's what we're seeing. Now we got to go, now it's here, I'm handing it over, so to speak, like the team. And now you guys wherever the next step is to go dig into it further. Like one thing that I had heard just recently is that, Social Security is obviously a big topic for a lot of clients. Well, I can't remember the number, but I think it was in the billions of dollars a year of Social Security being paid out to people that are quote unquote 150. So there's probably something that way that now that's being brought up, they can go investigate it further and see if they need to put any maybe checks and balances in place to make sure that people who are not living anymore aren't getting Social Security, which would help the some of that spending problem. But that's just one quick example that I think we saw that now it's brought to light. It's not an answer yet, right? Because now they're going back to figure out, you know, I think that's all it is right now is bringing it to light. And then the answers and how you address that, I think, are still yet to come. Is that, and so,
Yeah, well, exactly. Just at least re-examine when you're running this much of a deficit. Just we need to figure out how to be adjusting for it and where it needs to be looked at.
yes, yes. So anyway, we'll have some of that out there, kind of hit on the models, the data you just put out there. And I think the key here is what we're trying to do, and is if you look back at through the last State of the Unions, Guy, you and the team, what we're looking at is what's the data? How can we manage most efficiently and be good stewards for their clients' money? Looking at risk management, where are the opportunities? I think just to recap some of the opportunities this year you're seeing is maybe some of the ones that had been lower valued, that stocks for a while, and sorry, now I'm going to get tongue-tied, right? But kind of looking at where it's not just the top tech companies right now, but there's some more opportunity in some companies that were undervalued that are set for some growth based on some of these changes coming. And then you're always looking at for what might be areas of concern, as I think you've talked about, where companies that might be hit the worst with tariffs are not companies that you're even involved in at the moment, but continually watching that and looking out for what makes sense. So I don't know if you have any other quick closing thoughts you wanted to share, but I think it's important just to know that there is things being done on an ongoing basis, and I'm sure that if things happen and can continue with the speed that I think it's already started at this year, we'll probably jump on sometime in July and just do another quick, hey, here's what's happened so far. But any closing thoughts you have, Guy, I'm happy to.
Yeah, no, that's I think I hit on a lot of the themes. I mean, we have a good quarterly letter that goes even more in depth with graphs and pictures and visuals to kind of go with some of these discussion points. If anyone is interested in that, everyone has access to that, or if not, I know Michelle, you can
Yeah, we'll
easily get
post
them
that.
access to that, right?
Yeah.
But it is just hopefully a little bit for most people what I think they can take away from it is just a little bit of the depth of what we're looking at and the data that we're continuously kind of tracking and trying to help us make the best investment decisions from it's both from a top down and a bottom up perspective, from top down just the right places to be in, the right sectors, and then obviously it's very important on the bottom up that we're using the right types of companies, the right stocks to fill those areas. Um, so,
Right. And I think there was just one last thing about metals, gold, silver. We've talked about it for a long time. It has a place as kind of a wealth insurance type tool. There's been some talk on how things might change on the broader level with that. But again, right now, there's nothing definitive. And so yeah, I would say our stance is probably what it has been is metals are a great way to have, owning physical gold and silver, great way to have some wealth insurance. As far as on a bigger level, I think there's anything yet to be seen on what might come of that. But if you have any other thoughts you want to share on that, Guy, go ahead.
no, it's obviously it's gold. The metals have always been a little tough because the typical correlation has been slanted a little bit from different disruptive factors. But it is still, we actually were holding a position in gold in GL, using the ETF GLD to get the gold exposure, within a couple of our core strategies like growth and income and value. And gold had a good year last year, had a very good year last year. And it's that typical, alternative to, a little bit of that flight to safety, weakening dollar, strengthening gold. So, there's a component to have in, and we will tactically put in from an overall portfolio management from time to time. But like you said, the other aspect is, a smaller piece from as kind of an alternative asset that you're holding, kind of diversifies you away from just the dollar. Because our portfolios are very much invested in dollar denominated type companies because we're very much domestically allocated right now. Because the other thing we didn't really quite talk about was international. And when it comes to tariffs and things like that, it's another reason why we're very light on international because we talked about how strong our economy is, and that is not the same throughout the rest of the world right now. And especially if you do get the impact of a tariff or something like that, it could be very much worse for an economy that's still kind of teetering. So, but on the other end of that, being more domestically based, we're all very dollar based. So, gold, little piece in gold gets you a little diversified from the US dollar.
Yeah. And as far as again, anything else about that being revalued to offset the debt, I mean, nothing, again, we kind of talk about what's happening, what's specific, and then if something else happens and changes, we'll address that as it comes. But right now, not something on the radar. So that's imminent, if that makes sense, versus the other things that you talked about, tariffs and Doge are very much in the news and happening right now. So that's why we're kind of hitting on those things. So anyway.
Yep.
Well, with that said, again, I would encourage if you want to just see how things have progressed over the years, you can go to our website and on the blog section, just put in State of the Union. You'll see a couple different ones. They all have a little summary and see what happened from year to year. If you ever have any specific questions about your portfolio, Guy and our team is here to help answer those. But I think this gives you a general view on what is happening, what they're being done, and hopefully calm some fears that, again, despite how you might think something should be done or whether you like somebody or not, I think there was some good points um, that the debt ceiling was going to be creating and maybe the next big issue for the economy, for the stock market. So we're hopeful that some of this helps in a positive way. And I think that's kind of where we're at, and we'll make adjustments and kind of, as Guy says, as we see things happening, make adjustments accordingly, keep you updated accordingly. But there was obviously a need for something, and hopefully that something good comes from this, that we can get the spending under control that would help not just our government, right, but our economy and hopefully the market, which then returns to all of you in general. So I don't know if that kind of recaps your thoughts with it, Guy, but we'll kind of leave it at that and go from there. So hopefully
Yeah.
we'll get some more answers as time goes on. I'm sure we will. And so I will post next week. The video will be out, the recording with some links to some other resources as well, in there. So anyway.
All right.
All right. Well, thanks
Good.
everyone for jumping on Valentine's Day. And if you have any other specific questions, feel free to send us a message. We're happy to help answer, and do the best as guys. Is kind of our job, is to take the numbers, take what we see, and manage accordingly. And that's what you're doing. So thanks, Guy, for that. I appreciate it.
Yeah. My pleasure. All
Uh,
right.
All right. Happy
Everyone enjoy
Valentine's Day,
the day
everyone.
today.
All right. Thanks.
All right.
Bye.
Bye.